can hear me.
Yeah. People can hear us. We're just sort of sorting through, Dave. That's why we sorted through those major technicals for a few more people to join us, and then we will kick this off with David. So yeah, just hold fire for about another minute while looks like a number of people are logging in now. Okay, still got people logging in, so 30 more seconds and then we'll kick things off.
That'll give me 30 seconds to move the cat.
Okay, I will get this going because I'm hoping David's moved his cat now. First of all, thank you everybody for joining us. It has been 4 months since we had our last session with David. It's fantastic to have him back again. David Robertson is the Head of Economic and Markets Research at Bendigo and Adelaide Bank. He has a great insight into what's going on in the Australian economy and even wider in the world. So, you know, as we're coming right out the other side now of COVID, as vaccines are getting rolled out, as all that stuff's happening, it's pretty pertinent to hear about what someone who's really got his finger on the pulse feels is happening in the economy. Couple of little housekeeping matters. First and foremost, I'm sorry you only get to look at me today. David's got some issues with his camera, but you will get his slides. He's obviously got a voice or a head built for radio, so David's going to be doing it blind, but just through the slides. If you have any questions, please put them on the chat line, and I'll get to see them, and I'll get to chat to David. We might take a break sort of halfway through again, David, just if there's any questions and anything you want to ask. Yeah, and go from there. But right now, it's best if we all hear from David rather than me. So I'll put myself on mute and let you fire away, Dave.
No problems at all. Thanks very much, Guy. Thanks for that introduction, and it's a real pleasure to be with you all this morning again, and great to be back after the updates from last year to give a fresh view of where we're all up to. So good morning. Thank you very much, Guy, and to all of the Banjo team for the invitation to participate in this market update and to share some thoughts on what we expect from the economy and from the markets in 2021 and beyond. And yes, apologies that it's just the slides you're seeing, not my smiling face. But look, there's just so much happening at the moment, isn't there? Last year was an extraordinary year, and this year is continuing in that vein. So given that backdrop, and I know how busy everyone is, all the more reason for me to thank you for taking the time to join us. And I am looking forward to Q&A once I've gone through the slides, but I'll dive straight into it. And obviously the main thing I want to talk about is the economic outlook for the year ahead, which I remain not just cautiously optimistic about, which we talked about last year, but increasingly optimistic really, but with the caveat that it's all about the vaccine rollout to really build that bridge between where we were pre-pandemic and the post-pandemic economy. So really that's the rider for the predictions I've got today, which are relatively positive, and that might sound strange to be positive given how hard last year was, all the trauma from 2020, not just the trauma of having a recession, but the physical and mental stress that put us all under, and for a lot of businesses it's been the ultimate test, hasn't it? But recent economic data has been really, really strong, and it's hard to conceive that all of a sudden consumer confidence is at a decade plus high, and business conditions measured in the latest survey were actually at a record high. So, you know, it's been a real relief that the recovery has been this strong. And I suppose if you look around the world too and think about the comparatives, you know, where would you rather be than in Australia? So we've got a wonderful opportunity to leverage the strong position we're in, as long as we keep making the right policy calls. So look, I'll just keep clicking through the slides if I can. Right. Where's my mouse gone there? Maybe I can do it this way. Okay, that's disappointing. I think I might just have an issue clicking through slides, which is going to be a challenge. I might just try. This goes all right. The only thing I think I can do in this situation is a Control-Alt-Delete. Live. I think all I can do is end that and restart it. The alternative would be, I know you might have a similar version of these slides, would be to do them separately. Just bear with me for one moment, and hopefully, and we'll just try that again. Hopefully you can still see my screen, and I will press go.
Yep.
Okay, so hopefully this keeps going. There we go. If I have to reset the computer too often, I might pass back control. But look, obviously, the main thing I want to talk about is the recovery. Last year was all about the pandemic, and you know, we do actually get pandemics relatively frequently, and this one not as lethal as other pandemics have been over the decades and the centuries, but 3 million deaths from COVID-19 globally, fortunately under 1,000 in Australia. But the recession that's come from that, you know, it was a unique recession because it was a deliberate shutdown of the economy, and normally a recession comes when you go through the sort of economic cycle, the boom-bust cycle, if you like, but that wasn't the case this time. It was a deliberate rebooting of the economy, and so that means it's a unique shaped recession and therefore a unique shaped recovery. So the themes that I'd like to explore with that recovery are firstly around the new normal, and you know, the pace of that recovery to the new normal will really mirror the success in the vaccination rates. And so we're just so dependent on the vaccines because that's really the only way we're going to avoid further shutdowns and further delays in reopening borders. And it was great to see the Trans-Tasman bubble reopen, or to set up a bubble. But you know, the vaccination progress here and elsewhere throughout the world will determine how quickly that can happen in other countries. Secondly, I do want to explore the consequences of interest rates being this low. You know, this isn't going to be forever, but it is certainly going to be with us for this year and next. So what are the consequences of these ultra low interest rates? And is there a risk that the Reserve Bank are going to keep rates too low for zero incremental gain? And we do need to explore unintended consequences when we're in these sort of uncharted waters. And that's really where we are today. The world's never seen this level of fiscal support and monetary support. So what are some of the challenges that we'll need to look out for? And along those lines, I'd like to conclude by considering just how sustainable the recovery will be from recession, and indeed, what should we be worrying about next? And, you know, I thought it was great that we were able to tackle the pandemic by standing side by side with the scientists, the medical experts, standing, you know, next to the politicians in the media conferences. But what else do we need to worry about? And perhaps we can use a similar approach for other problems coming our way. So they're the themes I'd like to explore to build up to some predictions. I'll finish with 10 predictions for the year ahead. And that's normally how I do these presentations. I must admit, with our two presentations last year, the one in April and then in August, when we were in April of last year, the Reserve Bank weren't even making predictions. So I was a bit gun shy then. But just for context, if I can just revisit the predictions from last year, in April, these were the 5 thoughts that really consolidated my view. Firstly, that we were heading for the highest unemployment rate since the 30s, and that actually, you know, the effective unemployment rate got to 15%, even though the official rate only got to 7.5%. But that nevertheless, our view was that it would be a big V. I had the W as an alternative there, which turned out to be the case for Victoria, but a V for the rest of the economy and indeed for the Aussie dollar and for jobs. So I'm pleased that we made that call back in April, and indeed that that was going to be a buying opportunity for stocks and not a selling opportunity. So that was where we were in April. Then fast forward to August, when we last caught up. I think it was late August or early September. And then we had the outlook for global markets for Asia to outperform, which did happen. Trade wars morphing to tech wars. Certainly that's been sped up by Biden's victory in the presidential election. And I did say that Trump would lose if we had an election, which sort of only just happened in the way. When I say we, the US, well, in the end, a decisive victory in terms of 81 million votes versus 74, not that Trump ever conceded, but they were the predictions for global markets. Nationally, we looked at the Aussie dollar moving higher, which it did, at debt to GDP heading north of 50%, but retaining our AAA credit rating, which it did. And unfortunately, I did say that the RBA would be on hold at 0.25%, and as it happens, they cut rates in November to 0.1, so I'll take off a mark there. Fairly obvious, I suppose, with the state-by-state comparisons, Victoria to lag. Pleased that we were insistent that property prices would only fall by single-digit percentages, and indeed that they would rise in the regions, and unemployment to peak under 8% in terms of the state-by-state comparisons, which was the case. So pleased with those calls. All I can say about Donald is, if 81 versus 74 million doesn't sound like a loss, then I'm not sure how he scores his golf card. But anyway, let's move on. So that was last year. This year, I'll start off with perhaps the boring part, which is simply our baseline forecasts. And I've used a bit of a traffic light system here. So burgundy numbers show the actuals for last year, and then in black I've got the forecasts, including for halfway through this year. And definitely a green light for employment. We see the unemployment rate just ticking a little bit higher post JobKeeper, but back down to 5.25%, maybe 5.4% by the end of the year, and then into the 4s next year. Some of these will actually need some upgrading depending on how the next few months numbers go. GDP, we've got an amber light there. Still going to be reasonable growth. The half year, year on year will look better than it really is because of the sort of baseline comparisons. But for 2021, we see GDP picking up by 4%, maybe getting to 4.5%, and then 3% next year. So a reasonable clip, but it is going to be uneven and patchy, large variances by industry and even within industries. Confidence we see remaining elevated, and it's certainly elevated at present. We'll talk about the drivers of that shortly. Definitely a big bright green light for property, and you'd all be across how strong that is at the moment. Even our call of 7 to 10% price increases looks conservative. So I think there'll be some regions where it'll be almost double those sort of numbers. Trade, we've only got an amber light there, and I think with international trade, there is a reasonable amount of rebalancing given the collapse in service exports, most notably tourism and education, and also given the political challenges with China. But nevertheless, we are running a trade surplus, and we think it'll remain around 7 billion a month. I'll come back to the issues around China shortly. Inflation is the only red light on the horizon, and you could throw the lack of wages growth into that line as well. But we see two problems there. Firstly, that the RBA aren't going to be able to get inflation back into their 2 to 3% band this year, which is why they're keeping rates lower for longer. But secondly, we see a risk that the RBA will like other central banks, having to be dealing with rising inflation in the years ahead. So I think there's a two-edged sword there. But a green light for the Aussie dollar, moving steadily higher for all the right reasons, and the RBA on hold for this year and next. So that's our baseline forecast. Again, slightly ahead of consensus, other than perhaps for property, well ahead of the Reserve Bank's forecast. So why are we so positive? Firstly, if we just look at total job numbers, and again, I hope these slides are clear on your screens there, but obviously very happy to share them, and so you can have a look at them in a bit more comfort on your own screens there in due course. But if you look at total employment, 13 million Australians nationally with a job going into the pandemic. That fell to 12.11 million, and now we're back up at 13.1. So we've actually reclaimed all the lost jobs from last year and more. Now, the rising participation rates, which is a good thing, means unemployment is slightly higher than a year ago, but that's a great outcome, and that's a classical V shape. Obviously, a V can become a W, but the reason we project further gains for employment, even with JobKeeper having finished, is because of the level of job advertisements and job vacancies. And you can see job ads at a multi-year high, and job vacancies are actually at a record high. So we're more upbeat than the RBA are at present. RBA have only got the unemployment rates down to 6% this year. We're already down at 5.6, and they've only got it down to 5.5% next year. So that's going to need some fairly serious upgrades. Again, assuming we get positive news on the vaccination rollout and don't see any further deterioration on that. So that's a good outcome, obviously, given how disastrous things looked 6 to 9 months ago. Either way, we are moving to a new normal, but the V-shaped recovery has been really well defined, and it's a V-shape. Basically, as we declare war on, we'll declare victory on the war on the virus, and that will feed through to, borders reopening internationally more quickly, and also if you throw in the fiscal support, that is the reason the V-shape was so impressive. I showed this chart just before around employment. I'll show some more examples of the V-shaped recovery, certainly around job vacancies, which means even though we'll have a challenge around job mobility post JobKeeper, it means there are at least more businesses hiring and looking to rebuild in response to the rise in consumer demand that's coming through. Similarly, consumer sentiment, and actually since this chart was put together, we're up at about 115 on the Melbourne Institute Westpac survey, so that's a multi-year high. Similarly for business conditions, business confidence, they're all V-shaped, and so this chart, I suppose, is a bit of this slide's a bit of a celebration of our economic resilience. You could look at some of these numbers and sort of query, well, okay, that's great that we've recovered, but isn't that just because of the fiscal stimulus, which might be a bit of a one-off? But I think what we're seeing, and we're seeing this in retail sales as well, we actually get a fresh read on retail sales in about 10 minutes from the ABS. But not only, if I look at the black line there, so the total, not only was it a pretty brief V-shaped decline and then recovery last year, but we're actually about 9 or 10% above last year's or the pre-pandemic levels. So a lot of that cash stimulus has been accrued. It's still sitting in bank accounts. It hasn't all been deployed. And so that's accrued stimulus, which we expect to continue to support the economy. And of course, we've heard from the Reserve Bank that we can expect interest rates down at these levels for another 3 years. So it's been the ultimate V-shaped recovery, and that's been domestically. Obviously, within retail, there are a few exceptions there. Hospitality's been much slower to recover, and food went the other direction. So we all became household chefs, didn't we? But that domestic recovery has also been matched by our major trading partners, and China is a great example that they're China first economy to go into recession, first out, and you can see that their recovery has been sustained. So It's a V on all fronts. I suppose just for balance, one thing that hasn't been V-shaped has been travel numbers. In other words, international tourists and international students and so on coming here. That's very much an L shape. So we got up to, you know, 1 million a month coming to our shores, depending on the time of the year, prior to the pandemic. That's going to take time to recover, but you know, the travel bubble with New Zealand is a step in the right direction, and we hopefully will be able to replicate that with other countries. Perhaps I could have consolidated all these aspects of our economy into one V shape, and that is the Aussie dollar. And in a sense, the Aussie dollar is the ultimate barometer, isn't it? But you can see after that collapse down to 55.1 just over a year ago, suddenly we're back up at 80 cents and trading at about 76.25 this morning. So that ends the decade-long downtrend for the Aussie dollar, and I'd suggest we're now in an uptrend. And I think the A dollar is a really good overall barometer of our economic strength, certainly on a relative basis with the greenback there. So a V for victory. Very much helped by low interest rates as well as the fiscal policy. Just on the interest rate outlook, and when I say interest rates are low, you know, you've got a 90-day bank bill rate, I think, of 0.03% and a 3-year swap of 0.1%. It's just incredible how low these rates are. I see someone put together this chart showing interest rates over the last 5,000 years. So someone had a bit too much time on their hands as a COVID project to sort that one out. As it happens, other than the blip during the oil crisis of the 70s, interest rates have been declining for ever since we invented money. I actually have a suspicion this might be the turning point in interest rates, but maybe a little bit dangerous to call the end of a 5,000-year trend. But just for this year and next, we can expect the cash rate to remain at 0.1 for 2021 and for 2022. But you can see how the markets are factoring in rate hikes through 23 and beyond. You know, I think the risk is, and there's Australia on the bottom right, similarly for other countries with similar economies. I think the risk is that this will steepen and that the rate hikes, once they start, will actually be more aggressive than the markets are currently factoring. So we'll see how that goes. But, you know, to the extent that households or businesses have core debt, and not all businesses do, sometimes it's more around working capital, but I think it's such a great opportunity for households or businesses with core debt to consider locking in, because I almost can't think of a scenario where this isn't the low point in the interest rate cycle. So that's good news for borrowers, not so good for investors, and investors are busily going down the risk curve trying to get a return on capital. Don't go too far down that risk curve. Bitcoin price action's been pretty interesting lately, and non-fungible tokens, I'm not sure I'll be getting into them. But obviously good news for borrowers, including the government. And, you know, it was remarkable to see that budget deficit of 10% of GDP, 200 billion. And the last time we saw a budget deficit of that ilk was back in World War II. So, you know, I said it's been a sort of a warlike approach with the establishment of the National Cabinet, which I think it's just been so effective in driving, you know, really responsive policy settings. But, you know, in terms of that budget deficit, all of that money is basically borrowed. There's very little of that that's coming from tax. So if we add in blue there the federal deficit within yellow states and territories, what that means is this financial year, pretty close to 15% of GDP has been borrowed from the markets and distributed to the economy. So that's, you know, around about 300 billion, close to $1/3 of $1 trillion worth of direct economic support. And you might look at those numbers and say, well, again, isn't that just a short-term sugar hit that's been borrowed that needs to be repaid? And doesn't that just create problems around federal government debt? But as it happens, you know, I'm very comfortable with these levels of debts, both on a comparison with other countries, and also if you look at the interest repayments, our gross debt's heading for over $1 trillion. But because interest rates are so low, the actual interest bill on that is actually falling in the years ahead, which sort of takes a bit of time to get your head around. But we're going to be paying less interest on this debt than we were leading up to the pandemic, and a lot less than we were paying as a percentage of GDP back in the 90s. when we were trying to recover from the 91 recession. So I think that's all quite sustainable. Certainly not a problem for this year or next, but you could debate to what degree that will be a problem for later in the decade. The government's been busy borrowing money at these ultra cheap rates. So have households. One of the consequences of ultra low rates is that it is driving a property boom. And you might recall this sort of headline from a year ago. Will house prices plummet 20, 30%? Some people were saying. Fast forward a year, will house prices rise by 30%? So I think we can be a little bit cynical about some of the headlines. We're just trying to grab a headline, really. But if we look at property, and I think this is important for businesses because the rise in household property, well, the improvement in household balance sheets through the rise in property values will feed into consumer spending. But look, the dip from COVID-19 was much less than the dip we saw for property in 2018 in the wake of the Hayne Royal Commission and the tightening in lending standards. And, for a city like Perth, was on the decline due to the resources cycle, but that's turned up. So really, that's marked the end of the downturn there. If I just look, and maybe this will be a good place to pause for initial Q&A before I finish off the slides. But if we just look at the middle column here, so that's the first quarter of 2021, just incredible to see capital cities up 5.5% for the quarter, and regionals up almost 6.5%. And you can see the outperformance of regional property to capitals over the last year. So, I think this is a good news story overall. A lot of this has been driven by first home buyers and by owner occupier. It hasn't really been driven by investor activity to the same degree. And the Reserve Bank are looking at this and actually seem very comfortable about it, and they're not suggesting they need to put up interest rates yet to counter this trend. So look, I might just pause for a moment to see if there are any initial questions, and then let me know when I should plough through the rest of the slides.
All right, so I've got a couple just sort of floating in here, David. Just it's interesting, just sort of touching on what you've said there. First of all, well done on your predictions. Pretty well played. Only the interest rate one, but I don't think you'll be the Robinson Crusoe on that. So well played. And the V shape is obviously sort of coming through in spades and all the graphs and all the information we're getting here. First one, but there's a lot of stimulus and spending, and we just sort of, you've touched on quite a bit there. The interest rates are staying low. Surely inflation is going to return here at some stage. Yeah. And you would imagine, looking at that spending graph, households and everything still flying. I don't know, have you got any sort of thoughts on when that inflation spike will start to happen?
Yeah, I share that view, and it's interesting to read the Reserve Bank's minutes from their recent board meeting where they don't share that view, and their opinion is that it will take 3 more years, so through to 2024 at the earliest, to get inflation back within their 2 to 3% band. And they say that because they believe there's a dependency on wages growth to hit about 3.5% to drive inflation of about 2.5%, and they don't see wages growth back there until 2024 at the earliest. Now, my view is that actually, given how firm the jobs market has been, and the fact we've got unemployment back down to 5.6% so quickly, is they might be underestimating how quickly wages growth will return. And there certainly have been a lot of anecdotes of businesses, struggling to get suitable labour. And the other hole I'd pick in the Reserve Bank's argument is, it's not just going to be wages growth that drives inflation, and we're certainly seeing challenges. I've heard anecdotes of in construction just struggling to get a hold of all the parts you need that feed into whether or not it's construction or any business's dependence on supply chains. Those supply chains are less dependable. So the input goods, if you like, or the inputs are more expensive, and there's only one way you can respond to that. And consumers seem to be willing to pay for that at the moment. So yes, I do see even though I do expect inflation this year to be low, I think it'll be a quick turnaround, and that's why I think the interest rate rises in 2023 will be sharper than the market's currently expecting. So we'll see how that all goes. But maybe the central bank are just playing that down because they're trying to keep a cap on the Aussie dollar. I'm not sure how much conviction they have in their view that inflation won't increase.
Yeah, interesting. Thanks. So maybe more of a hockey spike type one.
Yeah.
Thanks, David. So all the surveys that you touched on too, business surveys an all-time high, and consumer sentiment is at an high. You work with a major bank. What's your bank seeing? Because I know talking with other people, there's just mass deposits there, and lending, which would sort of push a lot of that sentiment out there. So what are you guys seeing at the banks?
Well,
home lending is obviously going through the roof.
Yeah, but we are seeing it across the board, and you mentioned the deposits, and we had our bank results only a couple of months ago, and they certainly showed that, and I don't think there's been any real change in trend. So even though a lot of the money that's been distributed has been banked and therefore is accrued and not yet spent, nevertheless the inquiry levels, not just through home loans but across the board, are a lot higher than a year and a half ago, pre-pandemic. And obviously it's still very difficult. There's a lot of variation across different industries. And you think about the rebalancing, the fact no international tourism but plenty of domestic tourism. Our observation is that people are spending, so that those sort of spending trends are suggesting that okay, we've had to bunker down last year. We're now let off the leash, and with government payments to add to that, and people are willing to deploy that capital. So it's Victoria's lagging in some of that because we had the second lockdown, but it does seem fairly consistent with those surveys that people are more confident and they're giving it a shot. Now, that could turn around quickly if we see, what would be a disastrous scenario, say a vaccine variation, a virus variation that didn't respond to a vaccine. That would be a disaster. But that's really got to be an outlier, worst case, doesn't it? The baseline and even the upside scenarios are very positive, and that's being reflected in what we're seeing through our network as well.
Yeah. Okay. Yeah, that's great. Thanks. And look, final question, perhaps before we move on to the rest of the presentation. Those property prices were interesting. An observation was there was that even though Perth was kind of sheltered from the virus in a way because they locked down at the drop of a hat, their spike hasn't been as intense as say Sydney or WA as a whole, as New South Wales or Victoria. Is there any reason for that, or is that just purely the resources boom and now starting to come back a bit?
Yeah, it's definitely been a lag, but my view is that will actually outpace some of the other states given the commodity cycle, and I've got a slide on that shortly. But in the latest labour data, WA's unemployment rate is actually lower now than Victoria and New South Wales, and only lagging ACT. So I with the assumption that the resources boom continues, and I see no reason that it won't, I see those WA prices really catching up, whether or not that's Perth or regional WA. And regional's done it tough, but that's a resources boom is exactly what both Perth and regional WA needs, and I think that's what they're in for.
Okay, no, very good. All right, that's all we've got through from people at this stage. So I will, I'll let you continue. I'll turn myself off and let you continue, David.
Okay, that's great. Well, I'll run through the last few slides just in the next 5 or 10 minutes pretty quickly, but just to justify why we're calling 10% gains for property, or between 7 and 10% depending on the location. Owner occupiers been the main driver, but the investor side's starting to rebound. So housing finance is at a record level. Approvals, new construction, new home sales, greenfield lot sales, all at record levels or close to record levels. Now, again, you could look at that and say, well, hang on, doesn't that just mean it'll get out of control? But the Reserve Bank have been quick to point out that, the only reason there would be a problem would be if there was a deterioration in lending standards, and we're not seeing that. And secondly, they note that whilst Australia has had a nice little rebound there in blue, not as strong as elsewhere. And look at the Kiwis, they're up at 45% growth in 4 years. So I note that New Zealand recently did cut back on negative gearing and some of the capital gains tax exemptions. So that'll be interesting to see, the macroprudential response. But at this stage, the Reserve Bank has said no need to move interest rates. So if there is a bubble, I don't think it'll be in property. If there is a bubble coming, I actually suspect it'll be in parts of the stock market, although not our core stock market. And indeed, if you look at our ASX 200, which had its worst month ever a year ago in March 2020, we've just got back to 7,000. So we've taken a year to recover. Whereas if you look at the US, in particular the Nasdaq, they took only about 6 months to recover. And it's interesting to again compare our ASX 200 in blue with the Nasdaq in gold. Hard to believe they were both at 6,000. In 2017, we've got to 7,000, and the Nasdaq's gone to 14. But I do look at with some concern at some of the big tech stocks and just the astronomical PE ratios they've got. So, as I say, when you've got a 0.1% cash rate, investors need to go down the risk curve. They've really gone down the risk curve with some of this, but I think our returns are more sustainable. And in fact, again, keeping blue there for Australia, there's the US broader index in red. We're up 25% over 3 years. So we're making about 8% year on year compounding. And even if you go back 20, 30 years, it's still about an 8 to 8.5% return year on year compounding. And that's not a bad return when the cash rate's 0.1. So hopefully we can continue that pace. I do think it's going to be a bit challenging though for equities as interest rates start to rise. And as for this guy, if you've got any Tesla shares, I don't know about Elon. He's put $1.5 billion of his shareholder capital into Bitcoin. Might be a master stroke, or is that an early sign of a bubble? We shall see. But obviously with the stock market, it's good for super funds to be seeing those type of returns, because you're not getting it on deposits. Look, just on that question around sustainability, I've shown this chart around the business conditions actually have moved higher since, similarly with consumer. But to really answer the question, is it right that consumers and businesses should be this confident? I think the justification is, firstly, I think there are three main factors that came in at the end of last year. Firstly, the budget commitment, that $1/3 of $1 trillion worth of direct economic support from federal and state governments. Secondly, Biden winning the presidential election, and I don't just say that because I seem to have an issue with Trump, but more so to do with, I think, what the Biden administration will do for global cooperation, for trade. And it was good to see that recent conference with Biden's administration and the Chinese administration and the US sticking up for us and saying don't bully Australia. So I think that will help ultimately with our trade and perhaps with trade diversification as well. And thirdly, it was only late last year that we found out that the vaccines actually worked, that we saw 90% efficacy rates. Until then, it wasn't completely clear if they would work or not. So, obviously there have been some complications with AstraZeneca and so on, but a 1 in 200,000 chance of a blood clot is a concern. But even more concerning to me is a 2% mortality rate with COVID-19. So, it's been great to see that the vaccines have high efficacy rates. So I look at that and really view that the risk is all around the health crisis, and that's the primary risk to the sustainability of these confidence levels. And we saw last year that countries that had coped better with the virus, had lower fatality rates per capita, had better outcomes for GDP, and that included Australia. So I am looking at the vaccination rates. You know, we've only had per 100 people 5, I think it might be up to 6 vaccines administered per 100. UK and the US are up to 55, I think, in the latest count. So we've got a bit of catching up to do, but I think that's the greatest risk to the recovery, not other risks, including debt levels or even including the trade relationship with China. I note that even though there is the war of words, thanks to the elevated iron ore price and the demand for commodities, you know, we're exporting just as much to China as we have in the past, and some increases to other partners as well. And you know, iron ore is our largest commodity export, coal second. Okay, none of our coal is making its way to mainland China, whereas it was getting, you know, half to a third. But we're still exporting about the same amount of coal as we used to. So we're managing that trade diversification well. Look, just a couple of slides before I conclude. You know, I've talked about consumers and large business, but just on the SME side, and you know, it was devastating last year to see that it was small firms that were hit initially more than large firms. And similarly with cohorts of workers, it was lower income workers that bore the brunt of the virus rather than the other end of the scale. So at least those retail numbers have improved, and small firms are enjoying better demand across the board. It's interesting to see, you know, in the latest credit data that you would have thought there would be a spike in lending as a result of all this. That's, I think, going to come through in this March quarter. I think you'll see some sharp increases to lending, but it's actually been relatively subdued despite, you know, the low interest rates and the government incentives. And I saw in the Reserve Bank's minutes just the other day, they said that was due to a lack of demand as opposed to a lack of supply of credit. But as I say, I'm sort of glass half full about the recovery. You know, when we talk about employment, yes, we saw about 1 million jobs disappear pretty quickly, but we've recovered all of those, admittedly to different sectors. And so it's, you know, there's going to be less jobs in hospitality and arts and rec, you'd think, but more in some of the other sectors, including in, you know, healthcare and mining resources and some of the other services sectors. I think agri will do pretty well as well. The other point I wanted to make is it's really hard to, you know, make state-by-state comparisons, and in particular, if we look at the unemployment rate, they used to have a trend series with nice curved lines. They got rid of that during COVID, so we've only got these jagged lines to look at. But on a state-by-state basis, maybe if I just look at the raw data, so unemployment in March for Australia, 5.6%. Look at the ACT, 3.4%. But the outliers, you know, Victoria up above 6%, South Australia 6.3%. You know, I think the hangover from the second lockdown is evident, but population flows will be important moving forward, and I think they'll be favouring states like Queensland and WA. Interesting to see the Western Australian unemployment rate down to 4.8%. You know, for the commodity cycle to have turned as quickly as it has, you know, that's been very beneficial for WA, and I think Queensland will be the same. Not just iron ore and all, but copper is a really good indicator of the commodity cycle, and it seems to be very firm at present. And I think that does make sense given the infrastructure investment that we're going to be seeing for some time from countries all around the world. So, you know, in terms of that share of GDP, probably a little bit less from New South Wales and Victoria, a bit more from Queensland, WA. And in the case of SA Tassie, probably a little bit more dependent on tourism numbers and population growth. But certainly agri looks positive at the moment. I think that will help as well. My predictions to be held to account for the year ahead. Firstly, as I said last year, I think Asia to outperform, and that remains important for us given where our trade occurs. The vaccine will be the key driver of the recovery here and globally. So let's all get behind it. I do think the Biden administration, well, I'll struggle to reunite the US, but I think they'll do good things for global cooperation, for multilateral efforts, and I think that'll be good for trade. And I think that will also feed into a global reflation, which, as I say, is okay for this year, but problematic ahead. Stock markets are really tricky to make firm predictions on at the best of times. I do think they'll struggle as interest rates rise, but maybe it's more a case of, which businesses are on the right side of technology, innovation, and ESG. The 5 predictions for our economy: growth of 4%, maybe 4.5%. Regional economies outperforming, and we're seeing that in property prices. Unemployment to head down. I think I've actually improved that to 5.25%, but the low 5s, and then lower again into the 4s next year. Aussie up. I'll be controversial and say up to parity in 3 years, but I'm really basing that on the commodity cycle. And lastly, yes, our trade relationship with China has been tested, but I still think that exports will hold up, mainly due to increased demand from the rest of the world. So that's a relatively positive glass half full view. Normally I'd use this opportunity to make fun of a Trump tweet, but he's been banned from social media, so I can't do that. So instead I'll just make an 11th prediction that there's the next US president. The timing for Kamala will be interesting. So I'll leave with you my disclaimer and general advice warning, just in case any of those predictions turn to custard, but I'm very, very confident about them. So there you go. Let's hope the Roaring 20s are better in 21 than they were in 20. I'll leave it there, guys. Thanks very much.
No problem. Thanks, David. Look, a couple of little questions come out from that, and I'll just touch on them, and then we'll finish up for everyone, because we appreciate everyone's time. The stock market's going pretty high. There seems to be a bit of a massive jump in the IPO market at the moment, going crazy. Any thoughts on the longevity of that?
Yeah. So equities, on a PE ratio here, don't look expensive, whereas I think they do in the States. IPOs, and there seems to be a trend towards some of those new structures around them, to have them not securitized, but set up around, trust structures. I suppose when you're talking IPOs and the flow of capital, to what degree are investors going to want to be, taking on new investment opportunities and new risks, again, in a low interest rate environment? I think people do go down the risk curve. So look, really all I'll say is, PE ratios are probably the best guide as to whether or not the market is cheap or expensive, especially the CAPM, the cyclically adjusted. And on that basis, I don't think our market is ridiculously overpriced. It's probably a little high, but I am worried about those businesses that are carrying higher PEs. So an individual IPO is dependent on its own business case. So I'm not sure that I've got a sweeping statement there, other than I'd be more concerned about that in the States than here. I think our market is a little more sustainable given its price action than some of the other forces overseas. Yeah. Okay. No, very good.
All right. Look, probably just on the interest of time, David, we'll start to wrap it up. But first and foremost, massive thanks to you for presenting here again. Always insightful, always fantastic, and I love you sort of going out on a bit of a limb with company predictions. Thanks for bearing with us with the technical issues and working through those. Appreciate it. So yeah, massive thanks to you, and we'll chat again shortly. To everybody who tuned in, thank you very much. I hope you found it informative. We will share the slides around to attendees. So yeah, thank you very much for your time. All right. Thanks, guys.
Thank you.